I'm Rick Kaler. Thanks for joining me. Our economy is recovering. The stock market, it's booming, setting new all-time highs every other week or two. And yet, I'm hearing investors express much more fear right now than they did last March when the stock market was falling off a cliff. Now, why is that? Well, I see a couple of reasons for this. First, market movements are largely emotional, and they are unrelated to what is currently going on in the economy. Markets tend to go up when we feel they should be going down, and they tend to go down when we feel they should be going up. We tend to panic and sell stocks when evidence and logic say it's time to buy. We tend to panic and buy stocks when evidence and logic say, maybe it's time to sell. Well, I'd like to think the lack of panic among our clients last March was directly related to our efforts to educate. I think it was the short 11-day bear market that just didn't give people much time to react to fear. Today, only a small percentage of alarmed investors I have talked with seem to be worried about the market hitting all-time highs. The majority of those considering wholesale portfolio changes are largely focused on political concerns, including the collapse of the U.S. financial markets and the U.S. political stability. Worries of collapsing financial markets come from fear that the financial markets are rigged in favor of large institutions and the uber wealthy, and fear of hyperinflation driven by the trillions of stimulus dollars being injected into the economy. The fears of political unrest and instability stem primarily from concerns that the U.S. voting system is inherently corrupt, and the January 6th insurrection at the U.S. Capitol. Whatever the focus of investors' fears, the response is the same. Sell now and get out of any well-diversified portfolio. Go to cash, gold, and silver. This radical diversion from a well-constructed and diversified portfolio is understandable given the underlying fears. I mean, if I believed that most of these events were likely to happen, I'd do the same. Successful long-term investment success inherently demands social and political stability, fair and free markets, and a stable currency. Take away all three of those, you pretty much have a banana republic, not one to where you want to invest your retirement nest egg in. However, I really don't believe our markets are rigged, though they do have restrictions and controls, usually to maintain stability. Nor, despite my deep concern about the recent attempts to destabilize our republic, do I believe that we are on the precipice of anarchy. Our rising debt probably gives me more concerns around igniting potential inflationary pressures than how we will pay it back. Paying back any dollar-denominated debt isn't a problem for the federal government, who can create dollars with the stroke of a computer key. However, I don't fear that the almost $5 trillion in past and new stimulus spending will result in hyperinflation. In 2008, we spent $4 trillion propping up the economy. Hyperinflation didn't happen then, and for a number of reasons that I didn't understand at the time. A simple way of explaining inflation? Well, the old adage is too many dollars chasing too few goods. Right now, the U.S. has ample dollars sloshing about and more to come. But there's not a lot of chasing, which is rising demand with no increase in supply. Nor are there too few goods, because we're not at full employment, and we do have capacity to increase production. If we were at full employment with no capacity to increase production, then you could say there could be too few goods. We've learned from 2008 that creating trillions of dollars does not inherently mean hyperinflation. It doesn't even inherently mean inflation. Japan's debt level is over double ours. And they haven't been in a 30, and they are in a 30-year deflation. They haven't been able to create inflation for 30 years. They've been trying to hit just 2 or 3% a year, and they've done that unsuccessfully. However, if you're convinced that we will experience runaway inflation, you'd probably want to change your portfolio, and you'd want to own TIPS, that's Treasury Inflation Protected Securities, which index the interest rate to inflation, gold, commodities, absolute return strategies, money markets, and maybe some real estate. Other modifications could be to leave your diversified portfolio as it is and just put your whole bond allocation completely into TIPS. Now, I do recommend owning these asset classes in most diversified portfolios as an inflation hedge. However, I am not willing to bet my retirement on hyperinflation by owning them exclusively. Thanks for listening.